Thank you. Hi everyone, and welcome to our federal budget briefing. My name is Anne Germ. I'm the Executive General Manager of Morgans at Milton and also Ipswich. Thanks for coming along today to gain some insight into the announcements made in the federal budget last night. Surprisingly, there weren't too many leaks out to the media this year, and that's probably as a result of the timing being brought forward due to the election coming up, and any snippets that did come out were, of course, had quite a pre-election flavour to them. So we're pleased today to have Terry Bradford and Vanessa Azzini to present some of the key areas to us and unpack some of those, and perhaps see how the context around how that may affect you individually. First up we have Vanessa, who's the Director of Accounting at Strategic Business and Accounting Solutions, who is our business partner situated just next door. Vanessa is a certified practicing accountant with 15 years experience in providing business advisory and taxation services to public and private clients. Terry is the National Manager of Morgans Wealth Management nationally. She's the national manager. She's been working in financial services since 1995. This is her 16th budget. That sees Terry working into the small hours of the morning to make sure that all the Morgans advisors across the country have the up-to-date information when they get to work in the morning, and we're very appreciative of that, Terry. Thank you. So over to you guys. Vanessa's up first. Thank you.
Thank you, Anne. Well, so as Anne mentioned, I'm Vanessa. I'm the Director of Strategic Business and Accounting Solutions, and our office is just next door. So I'll just give us a quick plug. Done that right? So we've got a range of services that we offer to our clients. We've obviously got the accounting, so we do the compliance work. We have income tax, superannuation, so we can look after self-managed super funds. We also offer structuring advice, tax planning, bookkeeping, and business advisory. Alright, so I was quite disappointed with the budget last night because there's not a lot for me to talk about today. And I actually got to bed reasonably early. I got to watch the rest of the Karate Kid, So what does it actually have in store for you? So the main thing, last year Scott Morrison, who was the Treasurer at the time, actually rolled out his 7-year plan in the budget. Part of that was legislated last year with adjustments to what was actually announced in the budget. So this year, they've amended, the budget is proposing amendments to what they call the personal income tax plan, which is the 7-year plan adjusted. So the immediate changes are to the low and middle income tax offset. So they're increasing this from 530 to 1,080, and the base amount will increase from 200 to 220 to 255. So that actually affects middle income earners the most, rather than the lower income earners don't obviously receive it because they're not paying tax, but between 37, if you're earning between 48,000 and 90,000, it will increase from 530 to 1,080, and that's effective for this financial year. What they're also proposing is from July 2022, sorry, tongue twister, the top threshold for the 19% personal income tax bracket will move from the legislated 41,000 up to 45,000. The low income tax offset will also increase up to $700, and this will be phased out at a lower rate. And then the big one, which is kind of exciting for accountants, is to make things simpler. From July 2024, the 37% bracket will be abolished, and the 32.5% marginal tax rate will reduce to the 30 cents. So what does this mean? So I hope everyone can read that okay. So currently we've got the thresholds here in the 2000. So at the moment, if you're earning, say, $50,000, your top marginal rate is 32.5%. For the 19 to the 2022 year, the top bracket for the 32.5% increases up to 90,000, so that's actually current for now. And then that will actually increase in future up to 120. So it's actually quite a good system, good proposals. So you can earn a bit more and not move into the next tax bracket. And from 2024, where they're going to abolish the 37% tax rate, this is what it will look like. So up to $200,000, you'll only pay at the 30% bracket. So I think that's really, above 200, you'll pay 45%. So, all right. The other items that they announced in the budget, so the Medicare low income threshold, so when you actually start paying Medicare, has increased for families, singles, pensioners and seniors, and that applies for this financial year. And they also announced some tax exemptions to help out the farmers, the ones that have been affected by the North Queensland floods, as well as the big storm that went through October last year. So they've said we're not going to tax. So I'm not sure if we've got any farmers here, but that would be exciting news if I was a farmer. All right. For businesses, what they've done is they've increased the instant asset write-off. So if you're a small business with turnover of less than $10 million, if you buy an asset of $20,000, including GST, you can write that off if it's connected with your business. In January, they actually increased that threshold to $25,000, and then as of budget, as of 7:30 last night, they've actually increased it to $30,000. So we're actually going to have three thresholds for this current financial year. So it's going to be fun when we do depreciation schedules, remembering when you bought the asset. What they're also proposing is that medium-sized businesses, so that's between 10 million to 50 million, will also qualify for the instant asset write-off, which is probably the bracket that can afford to invest in new assets and probably got a bit more cash available rather than the small mums and dads businesses. The accelerated depreciation will remain. So the accelerated depreciation is where you pool assets. So if you buy an asset that's, say, $40,000, you add it to a general depreciation pool and you pool it at 30%, 15% in the first year, sorry. Okay, so the Treasurer also announced that they're giving more funding for the ATO for non-compliance, essentially. So one of those things is with ABN holders. If you have an ABN and you haven't lodged your income tax returns or you haven't lodged your BAS returns, what they're going to do is be chasing after you and actually say you can no longer hold an ABN. So I see that as potentially having a big impact on subcontractors. So subcontractors probably haven't done their tax return for a couple of years. It's at their bottom of their to-do list, and they won't be getting paid by who they contract to because they won't hold a valid ABN anymore because they're not lodging their tax returns. So that's actually going to apply not immediately, that's for something in the next 2 years. The ATO has been given more money to extend their tax avoidant task force. So this is looking at multinationals, larger corporations, high net worth individuals. They have got more funding to recover unpaid taxes, so those calls that you get from the ATO say someone hasn't paid their tax bill will be becoming more and more frequent. and also their superannuation liability. So they're going to be looking at employers who haven't paid their super guarantee. They say that it won't extend to the small business, but I don't know. I think the ATO will just keep chasing everyone anyway. So, and they're also setting up a sham contracting unit within the Fair Work Ombudsman. So this is actually aimed at employers having contractors who are really employees, but they're working under a contract, and that's aimed because the employer thought, hey, I'll get you to be a contractor, I won't have to pay you super, I won't have to pay you payroll tax, I won't have to have you under my work cover. So that's, and really they are an employee, so it's usually for people within the who do personal services income, so consultants, IT consultants in particular tend to fall into that category. So that's one of the measures that they're going to be introducing. I won't go too much into detail because Terry's the guru on super, so I'll leave Terry to talk about that. They are going to extend SuperStream, and that will give the ability to the ATO to be able to send electronic requests to withdraw money out of super funds for liabilities. Okay, so all these, what was announced in the budget last night is all very well and good, except I think today is the final sitting day for government.
Senate today, the House.
Sorry?
The Senate. The Senate today.
Senate
So
today.
it doesn't go through both houses today. It's not going to happen.
It's not going to happen?
And the House stays in.
Yeah. So we've got very limited time to get these proposals through Parliament. We are headed towards an election, so I think the important thing is to talk about what are Labor's policies, so how would that impact, because we've talked about the budget, talked about the proposals, and so these are some of the key items from Labor's proposed policies. So they're actually looking at taxing individuals 49% if you're earning more than 180, so whereas Liberals are looking at increasing the threshold up to 200 and then 45% over the 200 top marginal rate. Labor are looking at 49%.
It's plus Medicare, right?
Plus Medicare, all
temporary budget.
is plus Medicare. What they are looking at doing, and they haven't released a lot of detail on, is doing a 30% tax on trust distributions. It only applies to discretionary trusts, doesn't apply to unit trust distributions, or I'm not even sure about hybrid trusts, whether that will apply. And it's to adult beneficiaries. So it's not actually taxing the trust in itself, it will actually be taxing the individual on those distributions. So you might have a beneficiary who's in the 19% tax bracket, they receive a trust distribution, they would normally pay at 19%. The Labor is proposing that any trust distribution will be taxed at 30% if that's the higher marginal rate. Obviously, if you receive more money and you're in the next bracket, they're going to tax you at the next bracket. We don't know what impact capital gains will have on it, not sure about franking credits, how that will all roll through. There's not a lot of detail there. With the next 2 points, the negative gearing and the CGT discount. So negative gearing Labor doesn't like. They believe that it pushes up housing affordability. What they're looking at doing is going from 1st January 2020, you can no longer negatively gear on any new investments, so real estate and passive investments. They will grandfather the existing assets, so you can still deduct it, but any new assets purchased after this point, you'll no longer be able to negatively gear. CGT discount. Currently, if you hold an asset for more than 12 months, you sell that asset, you get an automatic 50% reduction in the assessable income that goes into your personal tax return. From, actually, I don't think they've actually, from same date, or they're not quite sure, they're actually going to reduce that discount to 25%. That, again, will only apply to new assets purchased after 1 January. So any existing assets will still get the 50% discount. The next one really just irks me. So they're proposing a $3,000 cap on deductions for accountancy fees. They call it tax management, managing your tax affairs. So they're going to place a $3,000 cap. Doesn't apply to companies, but applies to individuals and trusts. And I'm not sure about super funds. So, but a lot of work goes in. I won't get on my soapbox for too long, but a lot of work goes into giving tax advice. You might have one-off transactions that you might need advice on, and they're saying, no, you can only deduct maximum of $3,000. So I think this actually affects more people than what they realise. For instance, if you've got a client who hasn't done their tax returns for 10 years, they come to us and we say, it's all very messy, we're going to charge you $5,000 for 10 years worth of tax returns. They can only claim $3,000 of that. So I think it will apply to a lot more people than the high rollers that they're actually chasing. They are looking at taxing small and medium-sized businesses at a flat 25%, and so that's anyone earning up to $50 million or turnovers $50 million. And they're going to increase the Medicare levy to 2.5%. There are reforms on superannuation, but I'll let Terry talk about that in her presentation. And that's it. Thank you.
So, as Vanessa mentioned, I'll go through the superannuation changes and a couple of the other measures, and then again, because we've got Thursday night's redress from Labor, but also we have the election coming up in May, which could turn everything around anyway. Let's see what Labor are thinking about. So with the superannuation retirement, this, even if Labor support this one, and they've got no reason not to, this is a common sense proposal for 65 and 66-year-olds to not have to worry about that 40-hour work test. So 40 hours over 30 consecutive days. If I've retired after 65 and I want to put money into super, no thank you, I can't do it. So this makes sense because it aligns the super contribution eligibility criteria with the increasing eligibility for age pension, doesn't it? So that's gradually increasing to 67. So by 1 July 2023, we'll all have an age pension age eligibility at 67. So it makes sense that our contribution eligibility goes up to that as well, and anyone under age 67, if they're not working, like we currently have at age 65, can still do the contributions into super of your concessional and non-concessional. Of course, if you're an employer and you're receiving the 9.5% super guarantee, well then your employer, there is no age bracket on that, your employer is obliged to pay that 9.5% regardless of how old you are. Okay, it's actually one of the few ways to get money into super after even age 75. So the proposed start date is 1 July 2020, all right, so next year. So we still have 12 months. In that case, what has recently been regulated will probably get us over that, as long as it doesn't get retracted. But at the moment, and this was from last year's federal budget announcement, and the government didn't actually have to legislate this because it wasn't part of the Super Act. They could just regulate it, which was a good way of getting it done so Labor couldn't oppose it. But at the moment, if you're retiring, you're turning 65, let's say this financial year, because we actually are eligible now in this financial year, I'm retiring this year, so next year, 12 months over that next financial year, I can actually contribute into super without meeting the work test. All right, so that's good until our proposed measure of the 65 and 66-year-olds comes into play next year. Don't forget, you still now have this 12-month exemption for those contributions you may want to get. Now, the only caveat to this is total super balance. So everything we've got in superannuation, whether it's in pension or accumulation, my account balance can't be any more than 300,000. Now, for this, there's no such, right? That comes under normal contribution rules where if I've got 1.6 million in super, I can't do any further non-concessional contributions. Whereas here, at the moment, we're limited to 300,000 for someone to take advantage of that 12-month exemption, right? But, just a little example there, how you can still build up your retirement savings better than you would have under old rules, okay? What other super measures came through last night? It was fairly minimal, and that's a good thing actually. I think we've all had enough of super changes. Current age limit for spouse contributions, so that's where you can make a contribution on behalf of your spouse. If their taxable income is under a certain threshold, then you are able to claim it as a contributing spouse, you can claim a tax deduction.
Excuse me for a few minutes, please.
Sure.
Thank you.
So that currently is 69 years. That's going to extend up to age 74, okay? And that just brings it in line with the age 75 area for most other contributions, all right? So, you know, that's also going to take effect 1 July 2020. Reducing red tape for super funds, streamlining calculations. So if you've got a self-managed super fund, as a result of the super reform changes at 1 July 2017, accountants, and Vanessa would speak better on this one, that they had to then change the way they accounted for your self-managed super fund administration and tax returns in terms of whether they needed an actuarial certificate, whether we could segregate, or did we have to use a proportionate method. So the government is actually going back to, or winding back the clock and allowing accountants to actually operate on a similar basis to pre-1 July 17. So more details on that one. And Vanessa's mentioned the super stream. So there's going to be a consolidation of dates to 31st of March 2021 on this one, where we're going to expand the super stream standards, but the start date, they had recently announced self-managed super funds would be included in the rollover for, say you're rolling a fund from Australian Super, which is an APRA regulated fund, into your self-managed super fund. Previously, it was excluded, the self-managed super fund was excluded from SuperStream, but they said, no, you know, we're going to include it to improve the timely rollover of that amount as per any other APRA fund. We're going to delay that date now, according to the government, so that everything matches into that 31 March 2021 date. That may not affect a lot of people there, but from an administration point of view, that's more important for them. We had a few little funding boosts from the budget in terms of our aged care area, and look, you probably would have been living under a rock if you hadn't seen the news over the last 6 months, the nursing homes with their issues and elders abuse and things like that. So there's going to be additional funding from the government in terms of a better quality of care, for example. This is a program they're going to fund to strengthen aged care regulation and those compliance aspects in various new nursing homes they have to report to. They're also trying to promote staying at home. Okay, so the Commonwealth Home Support Program, where, you know, if you really don't want to go to an aged care facility, a residential care facility, you know, trying to allow you to stay at home and have that care come to you. So they're going to extend that kind of funding. So that's a good thing as well. What other measures? Now, interestingly, I'm not sure if you read the paper this morning or saw the updated budget announcement. We've got this one-off energy assistance program that was leaked outside the budget anyway. So singles will receive a $75 payment. Couples will get a combined $125 or $62.50 each. That's those who are qualifying for these various Centrelink payments as at yesterday's date. Now, what's missing? New Start allowance. Yesterday, or as at 9 o'clock last night, Josh Frydenberg was saying we're not including New Start allowance due to the fact most of them come off that payment in 12 months anyway. This morning, he's done a reverse on that, and New Start will actually now be eligible, or New Start recipients will be eligible to receive that one-off energy payment. Restoring trust in the financial system. Again, we all have been hearing and reading about the Royal Commission that went on last year. So this is just the government's response to the recommendations from the Royal Commission in terms of strengthening ASIC's position, APRA's supervisory enforcement activities, establishing a new authority to oversee ASIC and APRA regulators, so we're going to have a regulator that oversees the regulators, extending what we call AFCA, the Australian Financial Complaints Authority, and establishing an industry fund compensation scheme of last resort. So they're all parts of the Royal Commission. The government has just confirmed that funding and those acceptances in the budget last night. So again, not something that you see physically, but you know, in the background they're going to be working along. So, as I mentioned, that's what was happening from last night. What really might happen following the election in May. There's a few superannuation changes. I mean, I'll talk about franking credits in a minute, but the negative gearing and the CGT discount, the franking credits have all had a lot of playtime. These kind of have flown under the radar, as did the family trust changes. You know, not a lot of people realised about the 30% minimum payment on the family trust. First one, reducing your non-concessional contribution cap. So that's that after-tax personal contribution you make that goes into the fund without any contributions tax, okay? Currently we've got the cap of 100,000. That was previously 180,000, so we've already gone from 180,000 per annum down to 100,000 per annum. Now, Labor want to reduce that to a further 75,000. Now, when you think about the concessional contribution cap is down to 25,000 from what we used to have 50,000, 100,000 annually limited into super. I mean, yes, we've got that 3-year bring forward limit of 300,000, but it really begs the question, if you want us to be self-funded in retirement and reduce the reliance on age pension, because it is an affordability issue going forward, isn't it, with our ageing population, why are you continually reducing those limits to allow us to get money into super? The one in the green, the reinstate 10% work test for personal deductible contributions. The super reforms that came through in 2017 with transfer balance cap and all those other things, we called it the good, the bad and the ugly. Right? The transfer balance cap, the 1.6 million transfer balance cap definitely being the ugly. But the good of that was that scheme. Getting rid of that 10% work test for employees so that all employees could make a deductible contribution to super. I mean, they might work for an employer, a small business employer who couldn't, you know, physically accommodate salary sacrifice. They might not have known their cash flow. You know, small business particularly, income's quite sporadic. So at the end of the year, they may have had that surplus money, they got a bonus or something, they could contribute that to super under the 25,000 limit and claim a tax deduction. It was great. Opened up flexibility for people to save for their retirement. Labor want to take that 10% work test and reinstate it so that we're back to only those self-employed or substantially self-employed persons being able to make those deductible contributions, and employees are once again then back to just being able to salary sacrifice if they can. Abolish borrowing. Okay, again, there's been a lot of argy-bargy about, you know, reports coming out saying, look, it's okay, it's only on a small case. And no, it's not okay. It's, you know, the Productivity Commission said it shouldn't be there. You know, the government said, well, we don't care. Labor just don't like it. And really, on that one, I'm not fussed either way either. Commercial property, yes, it is a great way, especially if you've got a small business and you own the property that you lease your business from. It was great to have that limited recourse borrowing arrangement ability, but the Labor Party will get rid of that completely. You don't, for existing schemes, they will be able to stay as they are, and you know, you've got to eventually pay them out anyway under the tax office's safe harbour guidelines, where you've got to do monthly income payments, principal and interest. So existing arrangements can eventually be paid out, but any new borrowings won't be allowed, all right? Realistically, it's getting harder and harder to do, find a bank or a lender to borrow in this sort of way. I think Macquarie Bank were the very latest bank that pulled out and said, no, you know, we're not going to be borrowing under this arrangement. The high income contributions tax, so that's that Div 293. Now, this threshold was a relatively new concept again over the recent super changes, you know, in the last 10 years. When it was introduced, we had a 300,000 adjusted taxable income threshold, all right? Then from the 1 July 17 super reforms, that came down to 250,000. Now remember, I'm saying adjusted taxable income. So what does that mean? That means we take our taxable income that we declare in our return and we add to it any concessional contributions that we make. So the super guarantee from our employer, salary sacrifice, or personal deductible contributions. So if you're making up to your cap of 25,000, you're adding that 25,000 onto your taxable income, and that is your adjusted taxable income. So the threshold is now 250,000. Labor want to reduce that threshold further to 200,000. All right, now when you think, what's our top threshold? What's our top marginal tax threshold? 180, yep. So we take 180,000. If we are fully utilising our concessional cap of 25,000, 25 plus 180, 205,000. Vanessa, you should have got that straight away. So 205,000 is now, even though we're under that limit from a tax point of view, be mindful of what we contribute, because actually now we're over, aren't we? So 5,000 of that adjusted taxable income will be taxed at the additional 15% contributions tax, so basically 30%. All right, so that's something that could trap the unwary. And another one that was part of the good, the bad and the ugly, the good in the super reforms, in the orange there, abolish catch-up concessional contributions. So this is where people who have been out of work for a period of time, okay? Going to have a baby, I'm taking 12 months maternity, and I'm losing out on my employer's super guarantee because I'm not working. Under the catch-ups, exactly as it says, next year I go back to work, I can catch up the previous year's concessional contribution cap and add it to my next year. So I've got 50,000 now that I could get into super. Perfect for small business. Again, incomes like this. 1 year I'm not so good, next year I've had a cracker of a year, I've earned 40,000. I can look at what unused banked concessional contributions I've got, and I could actually contribute up to, if I've got it, up to 40,000 and claim a tax deduction instead of just 25,000. Again, it promoted flexibility and an ability to get money into our retirement savings in a good way. The Labor Party want to abolish that. So this is the first year it's actually been operating. It could be over before we know it, before we've had a chance to enjoy it. Now just out on the side there, it sort of fits in with what Vanessa was saying in terms of the CGT discount. We've got 50% individual discount going down to 25% under Labor's proposed policy. We have had clarification, which is good news. In the super funds, you get a discount as well. You get 1/3 discount, all right, in super. So from 15% down to 10% if you've owned the asset for more than 12 months. That's not going to change. Same with your small business CGT concessions, all right? The 50% discount as part of the concessions there, that will still remain at 50% as well. So at least that's something. Franking credits. I'm almost afraid to continue. As we know, the idea is from 1 July this year, and Chris Bowen again came out yesterday and was adamant that if they get in, this measure will go ahead on 1 July 19, regardless of whether legislation's been passed, they'll just backdate it or whatever, to abolish our surplus franking credits for individuals and super funds, applicable super funds. Now, the Alliance for a Fair Retirement System is a group of various associations around Australia. You've got the SMSF Association, you've got the Association of Super Fund Trustees, you've got the National Seniors Association, and so on. They've all formed an alliance in response to the franking credits ruling. And they've done a few stats and numbers and everything. And I just thought it was interesting for you to see how many people might actually be affected. And it's looking at nearly, just over 1.1 million individuals will be affected by these rules. And not a lot of them are high income earners, whereas what Labor says they're targeting. SMSF members, again, we've got an average 1.9 member fund basis or analysis. About 437,000 funds will be affected under this rule. Less you take off that pensioner guarantee that, they announced it in March, on the 4th of March or whatever it is last year, and then 2 weeks later they did a backflip based on concern from people and said, right, as at 28th of March last year, if you were in receipt of a Centrelink benefit, such as the age pension, disability or whatever, then you would be exempt from losing your franking credit. So you will still get the surplus franking credit. So if you take those exemption people out, then we've got about 358,000 that you subtract from the numbers. So we've still got over 1.2 million people being affected by this ruling. It's not just self-managed super funds, all right? There are a number of larger APRA-regulated funds. They've estimated about 50 out of the 240 that will be affected as well, where there's direct beneficial ownership of that member and tax is reported at the member level. They will also be affected under these rules. Any fund that reports at the fund level, where they can offset credits from the franking credits to debits on the members in accumulation, that's how they won't be affected. So for example, Australian Super Industry Fund, the makeup of that fund, 98% in accumulation and 2% in pension. That means that 2% of franking credits there can be utilised under their tax arrangements and their ability to offset the tax. They'll just absorb those credits, right? And to benefit those in pension, there'll be an uplift in the unit price of that member's pension account. So they don't physically see the franking credits anyway, do they? It's all in the unit price and how the earnings are adjusted. So, and of course, retired small business owners, they've worked, they've got a company, put everything into the business, and they've got the company working through thinking that at retirement, I don't have a lot of super, but at retirement, I'm going to slowly feed out those company franking credits, right? Well, they'll lose that franking credit surplus as well. So again, this is a chart from the Alliance, just showing exactly who will be affected under the franking credit rules. And you can see in this section here, more than 50% will have currently income less than 18,000. So this is where people will be affected. This is your high net worths, right? And from a self-managed super fund perspective, the green lines show the SMSF members claiming the franking credit refunds, and the orange line is the average excess franking credits claimed, right? So yes, this is the transfer balance cap, all right? So on that side of the equation, those with greater than 1.5 million balance, they had to bring back anything over 1.6 back to accumulation anyway. So if you've got 10 million that you had in pension previously, which is when these, the parliamentary figures were actually done for Labor, now we've got the 1.6 transfer balance cap. A lot of it's moved to accumulation, so they've got the ability to absorb those franking credits anyway, don't they? It's these guys who are just over the maximum asset test threshold, so around your 5 to 600,000 through to about your 1.6 or more likely 1.2. They're the bracket that are really going to see the effects and lose their income on that. Now, we've done our own submissions to the various parties. We've attended those Senate committee hearings. Anyone go to the Brisbane one? I went to that one. It was in Kedron about a month and a half ago, and I've never seen a group of more angry retirees in my life. It was really quite sad too to listen to their stories, because it wasn't just the retirees. There was a gentleman there who was 57 years old. He was only earning 75,000 income, had the family, and he had 2 sons, 2 young boys, and they had mental health issues. He used his wife, and he had managed to save a wee bit of share portfolio, and they were getting the franking credits through, and they used those franking credit surpluses to help pay for medication for their sons. So it's not all about the retirees as well. But this is one of our clients, all right? This is what we sent off in our submission. Got a single member fund, age 74 client, just over $1 million, all right? So in that sweet spot of what we're talking about. Not eligible for age pension, so won't, come under the exemption. They need $51,000 as annual pension payment to meet their living costs. Now, the way the fund is invested, the fund is paying them an income of $36,000 plus they're getting about 6,500 franking credits. So all up, the fund income, 42,500 against the 51,000 required. So of course, they do have to draw down some capital to meet the difference, which is about 8,500. Now, take away those surplus franking credits, and this client has to increase the level of capital drawdown on his fund to 15,000. If I'm drawing more from my fund, what impact does that have to the longevity of that fund and the capital lasting as long as I originally planned for it to last? So these are the things we need to think about, and you can see on the right hand side just the impact there. Now in terms of timing, 1 July 19 for the franking credits, the proposed super changes, the personal income tax changes that Vanessa talked about, so that's adding back that 2% temporary budget levy to make it a 49% tax rate, the discretionary trust tax changes, and then 2020, the negative gearing only being available on new homes and the capital gains tax discount. So, you know, over the next 18 months and whatnot, we're going to see, you know, if it gets in. But that's what I really wanted to stress to you today. It's got to get legislated, so, you know, we have to see what happens in the election. We need to then see how the Senate is made up, because we've got no legislation. Legislation has to be drafted in the first place. It then goes, you know, is introduced to the House of Reps. Once it's passed there, we go to the Senate. Now, it may or may not be referred to the Senate Economics Committee to make a recommendation as to whether to pass such legislation. If it's recommended and goes back to the Senate, how they vote on that then determines whether it becomes actual law. Now, the current makeup, there's no majority. There's a lot of reliance on the independents, isn't there? Now, each of the independents have actually come out and said they're not supporting, particularly the franking credit rules, all right? So keep that in mind, because there's a lot of talk about, should I wind up my self-managed super fund, or should I change my investment strategy, or, you know, sell out of this and go in and go into global international stocks? What we'd like you to do is just wait. I know that's a hard thing to say, but we don't want you acting in haste and regretting your changes, and I think the opportunity risk of what you might miss out on could be greater than actually not waiting, than waiting and seeing what comes to pass. All right, we're seeing a lot of companies already, you know, BHP, a lot of LICs are actually bringing forward and paying special dividends, including their franking credits. So they're bringing forward their franking credits. A lot of the banks, like Westpac, announced the bring forward of their actual dividend payment to the 27th of June rather than the 4th of July, so that it's in this financial year and you can claim those credits. If you sell out and change your investment strategy, you could sell some of those said stocks that are paying out, and you could miss out on that income. All right. Also remember, the chase for yield could incur additional risk or volatility to your investment portfolio. Think about what you're selling out of. Can you replace it with a similar risk type asset that's not going to cause you to lose sleep at night? All right? A self-managed super fund. Okay, so there is risk that you'll lose out on your franking credits, but why did you set up the fund in the first place? Because the fund you're in, whether it's industry, retail or whatever, wasn't giving you the flexibility and choice that you were seeking. All right, you're going to give all that up. If you wind up that fund, plus the cost of winding the fund up, are you going into a fund that's going to suit your retirement needs? All right, so we just ask, you know, hands up if you remember the 500,000 lifetime cap the government announced in a budget 3 years ago. Do you remember that? Well, 4 years ago now, 2015. So that when they were looking at the super reforms, they said we're going to do away with annual caps. We're going to introduce a 500,000 lifetime non-concessional cap. So then everyone jumped up and down and went, oh my God, I better see what I'm doing, ring the tax office, let's see if you've got records of what I've contributed, and then contributed extra into your fund. What happened? It didn't eventuate, right? They came back to the annual 100,000 cap, which meant all those people who contributed over 100,000 suddenly had excess contribution situations. Do you see what I mean? Like transitional retirement. Every year we hear they're going to get rid of transitional retirement pensions. So everyone looks at what they're going to do. Wait till things are legislated. Wait till we see the detail, and then we can decide. We'll work with you. We've published a number of reports black that you can't read. But similar to that one, you know, to help you work through as clients of Morgan's on, you know, where to consider in terms of investments. We had our wealth management publication that comes out in December. If you're a client of Morgan's, you would have received that, talking about the super changes on Labor side of things and all those things, and helping you understand what you need to do and what you don't need to do from that perspective. But please just calm the farm and let's see how we go on this. And that's it. Thank you very much.